G'day folks, welcome back to another upgrade, and today we're looking at high grade copper, which is consolidating, and US crude oil, which is overall bullish on all charts, but watch for a retrace on the smaller time frames. Before we go any further, make sure you hit that like and subscribe button. We're also going to include some back testing to show us a couple of strategies and how to test those. In terms of the outlook, high grade copper structural deficit of 200 to 300 kilotons a year supports prices as limited mine supply contrasts with growing demand, especially from the energy transition and electrification. Forecasts for 2025 range around $4.25 to $6.85 a pound, with consensus expecting a modest 3% price rise amid macro uncertainties. US crude oil short-term geopolitical tensions for Israel and Iran lifted prices near $76 to $78, but historical patterns indicate spikes fade without real supply disruption. Citi estimates a 15 to 20% lift to 75 to 78 barrels per day. If 1.1 million barrels per day of Iranian output is disrupted, though OPEC production and the US shale resilience keep ceilings lower. EIA projects Brent falling towards $60 by year end on rising inventories, waning demand and softer US rig activity. So first looking at US crude, have a look at the monthly, the weekly and the daily charts. The first thing we look at are the trends. And on the monthly, first off, the price is below the moving averages, although it's broken into that moving average range, giving us a somewhat neutral positioning. The CCI is also broken into that moving average range. So both price and CCI are moving towards a bullish momentum, very likely. On the weekly, the trends, both the price and the CCI are broken above the moving averages. That's bullish momentum. And on the daily, likewise, both price and moving averages are above the CCI above the moving averages. Now, the other thing to look at as well is any divergence. The next thing we look at. Now, there's no divergence on the monthly. On the weekly, there was no divergence there as well. And on the daily, if I zoom in here for a moment, what we look for is, in this case, higher lows on the CCI versus a double bottom on the price. That's a bullish divergence. You can see there it's broken up into our minimum range. And if I draw a target for those new to the channel, go up to that range there, it's a Fibonacci range. It's broken into that 23-38% Fibonacci range. So it's already broken into that range, and the CCI kept rising from there. So still maintaining further upside. Now, the next thing we look at on these long-term charts is these fair value gaps. And the fair value gaps are basically unfilled orders on the charts. And up here, for example, you can see here all these grey areas. Basically, we look at that candle there, for example. Let me just zoom into that one for a moment. You can see that candle there. You take the candle before it, the high, and the candle after it, the low. So that range there is what's called a fair value gap. They're basically unfilled orders, and we had another one up there as well. And what it generally means is the price generally gravitates back towards those areas, and it doesn't mean it's going to happen overnight. In this case, this is the monthly. It took a few months to play out, and eventually the price fell into those areas and it filled those orders. So we've got there, you can see there we've had a few other fair value gaps in that range there, a couple of small ones, but this one up here hasn't been filled yet. Again, you can see there the low of that candle there and the high of that one gave us that fair value gap with that range that I've highlighted there. So you may very likely see at some point a price reach that area up there, but notice also we've got another fair value gap down here. This one here has been filled with these candles, the dip of these candles. So that little fair value gap there has been filled. And this is the next area we need to look out for. This one here, back here, has been filled partially with the wick of that candle. But again, doesn't mean that the price, it will not keep going lower at some point. I don't trade these. I just look at it as a potential area, like a support resistance, if you like, of where the price may end up. That's the monthly. Got a high-end fair value gap up there and a low end. So at some point, we're going to see the price hit those ranges. And that could take years to play out. On the weekly, more closely, we've got this fair value gap up here. You can see that was drawn now on our last video. And since then, that wick of that candle broke up more than 75% of that range. So it's already somewhat filled that area. And we had other fair value gaps in there that have been filled as well. Another one down here hasn't been filled yet. So we might see the price retrace back down to that area as well. If I zoom in on the weekly, it's going back a bit. So you can see there's a few fair value gaps identified down there. I haven't highlighted them. But if I was to do that, let's do that now. Go to that range there. Those have not been filled yet. So we might see a price break to the downside at some point. And that also coincides with the monthly. So that's the weekly. On the daily fair value gaps, this one here drawn on our last video has been filled with these more recent days activities. And this one here down here hasn't been filled yet. But notice as well, we've had these other fair value gaps here. This one here more recently has been filled with those wicks of those candles. And it's currently still rising. So we'll keep an eye on that. We've got another fair value gap that hasn't been filled, so I'll keep an eye on that as well. And if I zoom out further, yeah, won't go any further. We'll just leave it there for the moment. We'll take it one step at a time. But like I said, that's been a bullish divergence, and the price broke up higher than that. Now, the next thing we look at is the intraday. So that's the daily. So we go to the intraday chart. So this is here is the daily, just as a reference. Bullish momentum predominantly, but notice here as well on the 1 hour time frame, you've got higher highs on the price versus lower highs on the CCI. Now you'll notice both the price and the CCI are broken below the moving averages, giving us a bearish momentum. Now don't go short here. I don't trade those positions. I want to trade in the direction of the daily. So only go long during that period, and I'll show you the back test of that in a moment. But first we've got to consider what's potentially going to happen here. So you can see there more closely, we had a fair value gap here with a spike up there when it happened that was last Friday. And since then, the price has retraced and filled those orders, and it's been going higher since. Had a couple of small fair value gaps in there. They've all been filled. This one's been partially filled, so you might see a bit of an upside there to fill the rest of those. But again, down here, we've got these fair value gaps that haven't been filled yet, so we're more likely going to see a break to the downside. Now, in terms of a bearish divergence, and that's what these trend lines indicate, lower highs and higher highs. We take a Fibonacci from that high, we take it back to the significant low. So let's take it back to that low, and we expect the price to break in that 23-38% range of the Fibonacci level. That's a minimum retrace. We expect it more than 90% of the time it hits that range. So again, we'll take it one step at a time, as I keep saying. If it breaks into that range, that divergence has been hit, but it keeps falling below that. We take it one Fibonacci level after another, and we may see it come down towards these fair value gaps. In fact, that also coincides with this support level we drew some time ago at 64.15. In terms of a back test, what I've done here is I've started this is the 1 hour time frame. I've started the back test going back to about the 8th of May when the daily broke high during that period. Here I've got the stop loss approach, and this is the average down approach. Now, at the very latest, you would have closed out your positions on either strategy around the 22nd of May, which coincided with this period back here. And you would have made back then about $1,500 on the stop loss approach and about $14,800 on the average down approach. And that's because you've doubled and multiplied your positions during that period. And avoid going long again until the price and the CCI break above the moving averages. And you can see there, going from that point on, you would have started going long again during that period. Now the stop loss approach here is, because it's been stopped out, has actually gone below our baseline of 100,000, and you're currently in the negative about $3,000. Whereas on the stop loss approach, if you let it run through the whole period, it's generated about 67,700. Again, always go at the very latest, you close out your positions when the daily hits the moving average of the CCI. But also notice as well, another good strategy is if you're following the 1 hour time frame strategy and you're trading on that time frame, back here you'll notice we did have a divergence. We had higher highs on the CCI, on the price, higher highs on the price versus a double top on the CCI. That was a bearish divergence. So at the very latest, when you started seeing this break below after that bearish divergence, when the price broke below that moving average range, somewhere around this area here, you would have closed out your positions. Then coming back to this point, if that was above the daily moving averages, you would have started taking long positions with a bullish divergence, higher lows on the CCI versus lower lows on the price. Now this case went sideways for a while. We had another bearish divergence here, so you should ideally close out your positions after that divergence, somewhere around there. And since then, as I said, we've got currently a bearish divergence. So if you're currently going long and you're making money on it, I suggest you close out your positions, especially if this starts breaking into that Fibonacci 23-38% range. Take your profits off the table. So for high-grade copper, what are the three things we look at? So again, we look at the long-term trends on the monthly, weekly, and daily. First thing we look at is the trend. So the price and the moving averages. The price is above the moving averages, and so is the CCI. That's the first thing. So bullish momentum at the moment on the monthly. On the weekly trends, the price is above, but notice the CCI is broken into that moving average range, giving us a neutral signal. So that's weekly. I would suggest it's a neutral positioning. Until that breaks above on the CCI, we'll create a bullish momentum. Otherwise, if that breaks below, that's a bearish sign, in which case we wait for the price also to break below the moving averages. On the daily, you can see there that's already broken below on both the price and the CCI moving averages, so giving us a bearish signal. So bearish momentum at the moment on the daily. So next thing we look at is any divergence, and on the monthly, we've got a very long-term bearish divergence, and you can see there that's already broken down on the monthly. It's with that wick. It's broken quite strongly to the downside, but could actually drop further, to be honest, but let's leave it at that for the moment. It's actually hit that target range on the monthly. On the weekly, there is no divergence to talk of. The CCI is moving in alignment with the price, which is what we normally want to see. And on the daily, there is also no divergence that I can see. So that's moving in line with the price as well. Next thing we look at is any fair value gaps. Now if I zoom out on the monthly first off, these areas down here haven't been filled. This one up here, just zoom in on that for a moment, these fair value gaps here have been filled with that price action with those candles there. Now this is a very long-term play, so don't go placing short orders based on this. We've got fair value gaps down here which haven't been filled, and that's why I've drawn this rectangle. So we'll take that one step at a time based on the weekly and a daily as well. So, but don't go placing short orders based on that. On the weekly, this fair value gap more recently has been filled with these wicks and those candles. These ones back here have been filled, and going back to there, they've all been filled. And again, just looking back at that recent history, there's no fair value gaps to identify. On the daily, again, going back to these ones, we had all these areas have been filled, those fair value gaps, with the exception of that one up there. So that still remains unfilled, and we may see price action reach that level at some point. Again, we don't buy based on that alone. We trade in the direction of the daily. In this case, it's going down, so we don't take long trades, we take short trades once we see the CCI, as I said, and the price break below the moving averages. So don't go trading long based on that alone. They just basically call that a support or a resistance level at this point. And if I zoom out, there's no other fair value gaps that I can see. Now if we go to the intraday chart, again we're using here the daily, which is showing consolidation, but predominantly short trades to be taken. And likewise on the 1 hour time frame, short positions to be taken. So I'll show you the back test in a minute. But at the moment, if you zoom out on the 1 hour time frame, I've identified here some fair value gaps. This one here hasn't been touched yet. Those wicks came close, but we want to see that breakthrough and penetrate most of that fair value gap. And likewise up here, we've got another longer, higher ranged fair value gap. This one down here has been filled with those candles. So that is already actioned, and I can't see anything back there. So that's where we are on the 1 hour time frame, predominantly short positions to be taken. And just be aware that that still hasn't been filled, that fair value gap up there. Now I'm going to show you some long trades that would have been taken based on the daily when the CCI broke above there, and based on the long positioning that started back there around about the 20th of May. This is the stop loss approach, and this is the average down approach. Remember, we always close out your positions, especially if the daily breaks into that moving average range. So the first time you would have closed out your positions around this period. And also notice you've got a little, very tiny bearish divergence, and you would have, even if that wasn't showing a bearish momentum on the daily, you still would have closed out your positions based on that divergence. Not taking any long trades during that period there. the price and the CCI declining, and you would have started taking long trades there so long as the daily was also in a long position. Until such time you saw this bearish divergence emerge, lower highs versus higher highs on the price, and you would have closed out your positions once you start seeing that moving average range breaking to the downside. So you would have closed out your positions there. But what I've done here, I've left a run through the whole period, and I'm not suggesting you do that. And you would have closed out the last long positions you would have closed out at this point here when the daily was also breaking down during that period there. So you would have, at that point around that area, you would have closed out. Stop loss approach would have generated about $1,500, and the average down approach would have generated about $17,000. Again, you would have closed out your positions where the bearish divergence started playing out. So if you're new to trading, want to get some more insights into how do we trade some of our strategies, we're including a video series, Pete's Investing +1, as identified by the +1 symbol there. And the videos are a dumbed down version of our strategies and give you a better insight into our analysis. If you enjoy the content, feel subscribed at least on a free trial to my Patreon page, where I publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you in our next video.